Do you understand what stock market volatility is and why it's important? If not, let's demystify it together. In simple terms, volatility refers to the degree of variation in the price of a stock or the overall market over a certain period. Picture it as the market's mood swings, sometimes calm, sometimes turbulent. It's a statistical measure that shows how much and how quickly the price of a stock or the market as a whole changes. High volatility means larger price swings and vice versa. Now, why should you care about it? Well, understanding volatility is crucial for both investors and traders. It significantly impacts investment decisions and risk management. It's like the weather forecast for sailing. Knowing when to expect calm seas or rough waves can make your journey safer and more efficient. And there you have it. Volatility is a key concept that plays a significant role in the stock market and investment decisions. Several factors influence market volatility. Let's delve into the primary causes: market sentiment, economic data, corporate earnings, and geopolitical events. First up is market sentiment. This refers to the collective attitude of investors towards the market or a specific stock. It's a powerful force that can drive prices up or down rapidly. Think of it like a tide in the ocean. When the tide of sentiment is positive, it can lift all boats, or in this case, stock prices. But when the tide turns negative, it can drag everything down with it. Next, we have economic data. This encompasses various economic reports such as employment numbers, GDP growth, and inflation rates. These reports can create waves in the market, causing prices to fluctuate. For instance, if a report shows that the economy is doing well, investors might feel more confident and start buying, pushing prices up. Conversely, if the data indicates an economic downturn, investors might start selling, leading to a drop in prices. Moving on to corporate earnings. These are the profits that companies report every quarter. These reports can significantly impact a company's stock price. If a company reports earnings that exceed expectations, its stock price might soar. On the other hand, if earnings fall short of predictions, the stock price may plummet. Last but not least, geopolitical events. These include political instability, wars, and other global events. These situations can create a lot of uncertainty, and as we know, markets despise uncertainty. This can lead to rapid price changes as investors try to navigate through the murky waters of geopolitical unrest. In summary, these factors, market sentiment, economic data, corporate earnings, and geopolitical events, all play a part in creating market volatility. They can cause prices to rise and fall in the blink of an eye, leading to larger price swings and consequently higher volatility. And so we see, these factors can cause prices to fluctuate rapidly, leading to higher volatility. There are different types of volatility and ways to measure it. One of the most commonly referenced volatility measures is the volatility index, or VIX. Sometimes referred to as the fear gauge, the VIX gauges the market's expectation of future volatility. When the VIX soars, it implies that investors anticipate larger price swings ahead. Now, let's delve into the two main types of volatility: historical and implied. Historical volatility, as the name suggests, scrutinizes past price fluctuations of a specific stock or market index. It offers a peek into the past, revealing how volatile an asset has been over a given period. On the other hand, implied volatility gazes into the crystal ball of the future. It mirrors the market's expectations for future volatility and is a key component in options pricing. When implied volatility rises, options become pricier. This is because higher volatility increases the likelihood of an option reaching its strike price, thereby increasing its value. It's important to note that these two types of volatility often diverge. Historical volatility is a factual record based on past data, while implied volatility is a forward-looking projection based on market sentiment. Consider this: if a stock has been stable for years, low historical volatility, but is expected to undergo significant changes, high implied volatility, the price of options on that stock would increase. This is because the risk and potential return associated with that stock is perceived to be higher. Conversely, if a stock has been wildly fluctuating, high historical volatility, but is expected to stabilize, low implied volatility, the price of its options would decrease. In essence, understanding the different types of volatility and how they're measured can help investors anticipate and respond to price changes. It allows them to gauge the level of risk associated with a particular investment and make informed decisions. Whether you're a long-term investor or a day trader, knowledge of volatility can be a powerful tool in your investment arsenal. Understanding the different types of volatility can help investors anticipate and react to price changes. Volatility significantly impacts investment strategies. Let's break down how this happens. Volatility holds different implications for different types of investors. For long-term investors, those with a broad investment horizon, short-term volatility might not be a significant concern. In fact, they might even see it as an opportunity. How so, you ask? Well, when the market is volatile, asset prices swing. This could mean that some assets are momentarily undervalued. For a long-term investor, this is a golden opportunity to buy these assets at a lower price and hold on to them until their value appreciates over time. Now let's switch gears and talk about traders. Unlike long-term investors, traders often thrive on market volatility. Why? Because volatility presents them with numerous trading opportunities for quick gains. Picture this. A trader buys a stock at its low point and sells it when it reaches a high point, all within a short time span. That's a quick profit right there. But remember, higher rewards usually come with higher risks. While traders can make significant gains from volatility, they can also experience substantial losses if the market doesn't swing in their favor. Now, whether you're a long-term investor or a trader, risk management is crucial. Why is that important? Because understanding volatility helps in managing risk. Diversification is one way to do it. Spreading your investments across various assets can help mitigate the impact of price swings. Another strategy is setting stop-loss orders. This limits your potential losses by setting a predetermined level at which to sell if the price drops. Using options is another risk management strategy. Options contracts can provide a hedge against potential losses in volatile markets. In essence, volatility is a double-edged sword. It can present opportunities for high returns, but it also introduces greater risk. Understanding volatility and knowing how to navigate it is key to successful investing. And remember, while volatility might seem intimidating, it's a natural part of the investing world, so embrace it. Knowing how to navigate volatility can help investors maximize their returns and minimize their risk. Measuring volatility and understanding its impact across different asset classes is crucial. So how do we measure volatility? Common tools include standard deviation, which quantifies how much a series of numbers deviates from its mean, and the average true range, ATR, which calculates the average range between the high and low prices of a stock over a specific period. Another tool, Bollinger Bands, uses standard deviation to create an envelope around a stock's moving average, indicating levels of volatility. Different asset classes like stocks, bonds, and cryptocurrencies exhibit varying levels of volatility. Generally, stocks are considered more volatile than bonds. This is because stocks are equity instruments and carry the risk of the company's performance, while bonds are debt instruments and carry less risk as they pay fixed interest. Cryptocurrencies, on the other hand, are notoriously volatile due to their relatively new presence in the financial world and their sensitivity to market sentiment and regulatory news. Now let's talk about the impact of significant market events on volatility. Major events such as economic crises, geopolitical instability, and global health emergencies like the COVID-19 pandemic can cause sudden and extreme spikes in volatility. These events create uncertainty, which can lead to rapid price swings as investors react to changing conditions. For instance, during the financial crisis of 2008, the stock market experienced extreme volatility as investors panicked and rapidly sold off their holdings. Similarly, the outbreak of the COVID-19 pandemic saw a significant increase in volatility as countries went into lockdown and businesses shuttered, causing uncertainty about the future of the global economy. Understanding these factors can help investors make informed decisions about their investment strategies and risk management. For example, an investor with a high risk tolerance might be more comfortable investing in volatile asset classes like stocks or cryptocurrencies, while one with a lower risk tolerance might prefer the relative stability of bonds. Remember, different assets have different levels of volatility, and major market events can trigger sudden volatility spikes. Stay informed, stay flexible, and always consider volatility in your investment decisions. Investor behavior and risk tolerance also play a significant role in market volatility. When panic ensues during market downturns or excessive exuberance bubbles in bull markets, abrupt price movements can occur. This is often driven by herd mentality, where investors follow the majority, whether they're selling off or buying up stocks. Moreover, understanding your risk tolerance is pivotal in navigating volatility. If you're a conservative investor, volatility might make you uncomfortable, leading you to opt for less risky asset classes like bonds. On the other hand, if you have a high risk tolerance, you might see volatility as an opportunity to potentially reap higher returns from riskier assets. In conclusion, stock market volatility is a natural part of investing. It's not necessarily a bad thing, but it does require understanding and careful management. Embrace it, manage it, and let it serve your investment goals. Understanding and managing stock market volatility is crucial for successful investing.